Good morning, everyone. Welcome to the 11:15 session of our Phillip Securities Research Morning Call for 29 August 2022. For today, we have a few stock counter result updates and also Phillip on the ground. And for technical analysis wise, we have Home Depot and Yangzijiang Shipbuilding. And as usual, we'll end the session with with the Singapore weekly. So without further ado, let me hand over to my colleague Jonathan to share on the results for TDCX.
Thanks, Ian. Good morning, everyone. So today I'll be sharing TDCX's second quarter 2022 results. Just in case you all didn't really know, TDCX is actually an outsourced customer service company. So I guess the most basic would be like your call centers. Whenever you call in for forget your password or something like that, there's one aspect they do, and that falls under their omni-channel CX segment. In terms of sales and digital marketing, they help companies to improve and get higher yields on their digital marketing. And for content, trust, and safety, it's basically another word for content moderation. So they moderate a lot of your Facebook posts, a lot of the chats in certain video games and stuff like that. So in terms of their performance, their first half revenue was their first half revenue and PATMI was at 47% and 56% of our full year forecast. They recorded 162 million Sing dollars in revenue and about 27 million Sing dollars in PATMI. And they also recorded about 19 cents for their EPS. In terms of their positives, they had about 15 client additions for the second quarter and 25 additions in total for the first half of 2022, which was 3 times more than the first half of 2021. So some of the new clients included leading regional airline, leading integrated car e-commerce platform, 3 fintech companies, and 1 insurance company. So new client additions drove revenue up about 23% year-on-year, and also strengthened TDCX's leadership in e-commerce, travel, and fintech verticals. So the company also saw about a 40% year-on-year increase in launched client campaigns, demonstrating an increasing ability to accelerate campaign growth while maintaining low levels of revenue churn. The second positive we see is that they are expected to benefit from the global rebound in travel and hospitality. One of the reasons for this is because it has a very strong travel and hospitality is one of its strongest verticals. Revenue from this vertical grew about 25% year-on-year, obviously boosted by the upward momentum in travel. Although this number is still about 16% shy of its pre-pandemic peak, we still think that the potential reopening of other countries in North Asia, especially China and Japan, should provide some optimism for increasing revenue contribution moving forward in the near term. Our third positive is that they had an expansion of adjusted net margins, mainly due to reducing expenses. One reason why we use adjusted net margins here is because there was a stock-based compensation program that they introduced in the fourth quarter of 2021. So this wasn't present in the second quarter of 2021. So just to make a slightly more accurate comparison year-on-year, we took that out and we used the adjusted net margins. So this came in at 19.2% for the first half of this year versus 17.8% for the first half of last year. Like I mentioned, the main reason for this is a sharp decline in interest expense. So they actually paid off all of its long-term debt and a significant portion of its short-term debt. In terms of the negatives, there's a higher than expected tax rate. And this was mainly due to tax reliefs, a suspension of tax reliefs in Malaysia and Philippines. So tax rate for the quarter was about 27% versus 21% in the second quarter of last year. They had a one-off prosperity tax in Malaysia, and they also had a suspension of a tax holiday in the Philippines. So in terms of the outlook, the management was actually quite optimistic for the rest of the year, especially to meet their revenue, their full year FY22 guidance, revenue guidance. The company also continues to diversify its client base, both geographically and vertically. So they are expanding into more countries, different countries globally, and also expanding into different verticals. Um, uh, yeah. The company also continues to focus on M&A to accelerate its growth strategy. So it does have a healthy pipeline of potential acquisitions, but they are also quite picky on who they want to acquire and how they want to acquire moving forward. As it definitely looks to deploy some of the cash that it raised from its IPO. So right now it has about 385 million Sing dollars on its balance sheet. In terms of valuations, we raised our FY22 PATMI by 9% to 96 million Sing dollars, mainly to reflect expanding margins due to low expenses. We also increased our EBITDA forecast slightly and reduced capex for the year by 60%. We also increased our WACC from 9.7% to 10.4% to reflect a rising interest rate environment. We maintain a buy with an increased target price of $16.39 US dollars from our previous target price of $15.76. With a WACC of 10.4 and a terminal growth rate of 3%. Now moving on to Marathon Digital Holdings, we're doing a Phillip on the ground. They had because they had held a webinar with us this last Friday. So this company is non-rated and closed at a price of $11.35. So in case you all didn't know, Marathon Digital Holdings is a Bitcoin mining company. They've got a current market cap of about 1.3 billion US dollars. And their market cap is heavily tied to the price of Bitcoin because they hold most of the Bitcoin that they mine. So just based on they just hold it on their balance sheet. So obviously, if the price of Bitcoin increases, then the valuation of the company increases. In terms of their business model, they are an asset light. So you don't really own any infrastructure. The only depreciating assets they have are miners because they are revenue generating assets. Like I mentioned, they are hodlers of Bitcoin. So hodlers are holding on for dear life, so they don't really sell unless there's an opportunity or there's a need to sell. They also do try to focus on cheaper, preferably renewable energy sources to power their miners. In terms of their revenue for the first half of this year, revenue grew almost double. It grew 99% year on year. And the interesting thing is that revenue is recognized according to the price of Bitcoin when it is mined. So assuming it's mined every hour, the revenue will just be recognized according to the price of Bitcoin at that particular point in time. For the year, the company produced about 2,000 Bitcoin, which was up 58% year on year. One of the reasons for this is that they just deployed a lot more miners. So in Bitcoin mining, it's really it's very important to have scale. I mean, the more miners you have, the larger scale you have. Generally, the more Bitcoin you will mine. In terms of its mining fleet, it has a goal of achieving 23.3 exahash per second of computing power by the middle of next year. And how they basically are planning to do this is just to upgrade their miners and buy more miners and deploy them accordingly. About 10,000 miners is equivalent to about 1 exahash. In terms of their second quarter highlights, Bitcoin production was up 8% year on year, but down 44%, mainly due to energization delays and weather-related issues. In terms of some news and updates, they had about 68,000 miners installed and are waiting to be energized in their West Texas facility. I believe some of them have already been energized. Energized means they are just turned on. So they need to get, the company needs to get approval from regulators and state authorities before they can actually turn on their miners to make sure that it doesn't overload the power grid. They also had got into agreement with Applied Blockchain to secure hosting capacity, which essentially is a warehouse or several warehouses to house their miners. In terms of their outlook, they are still bullish on the long-term prospects of Bitcoin, although it is going to be dependent quite heavily on the use cases that Bitcoin can provide. What I'm seeing right now is that there's already significant institutional adoption for Bitcoin. So that's all for Phillip on the ground for Marathon Digital. Move on to my next Phillip on the ground, which is on Grab Holdings. So in case you all didn't know, Grab is a $12 billion company. It's also non-rated. They are a super app providing services in transportation, food delivery, digital payments, other digital financial services. In terms of their revenue for the quarter, increased 85% year on year. In terms of breakdown, deliveries make up about 42% of revenue, with mobility making up half of all revenue. For deliveries, it's just your Grab Food and GrabMart deliveries. GMV grew 90% year on year. GMV is your gross merchandise value, so it's the total value of products sold over a given period. Revenue grew about 200% year on year. The main reason for this is that they increased their take rate by 2.8%. So take rate is just another word for commissions. I guess the fastest way for them to make money is just to increase the prices that they take from all deliveries, and that's what they've done here. A lot of the GMV growth is also driven by Jaya Grocer, so they actually acquired Jaya Grocer in the first quarter of 2022, predominantly to serve their grocery delivery business in Malaysia. And incentives as a percentage of GMV was down 47% year on year. So they're actively trying to spend less in terms of incentives, as they're trying to become more profitable. GMV was below guidance slightly, mainly due to FX headwinds. In terms of mobility, which is just your Grab transportation, GMV grew 51%. And this was mainly due to a recovery as most countries started lifting a lot of their travel restrictions. In terms of financial services, which is your GrabPay, your buy now pay later products, TPV, which is your total payment volume, grew 31%. And loan disbursements, which is quite interesting, grew about 169% year on year. In terms of for summary, revenue growth was pretty much in line, but widening losses were way below expectations. The company expects FX headwinds to be in the region of 4% for the second half of this year. And they actually lowered their GMV guidance due to increasing dine-out trends. The company's main aim is or main goal moving forward in the mid to near term is to reduce incentive spend. They actually pull forward their deliveries break even, so they expect the delivery segment to break even in the second quarter of 2023, 2 quarters prior to their earlier estimates of fourth quarter 2023. So that's it for Grab. My next Phillip on the ground will be on Unity, who also held a webinar with us on Thursday. Unity is a $15 billion company. They are a 3D real-time content creation platform. So you can see here some of the pictures here, like Hearthstone, Pokemon Go, and Fall Guys. I'm not sure if you guys if you guys know what these are, but I'm sure your kids would know. These are just games that leverage on, that actually use the Unity content engine to create their products. Revenue for Unity for the second quarter grew 9% year on year. And they also have predominantly 2 main revenue segments. One would be Create, which is 41% of revenue, and Operate, which is 53% of revenue. In terms of content, Create, it's a content creation engine. So mainly focusing on visual scripting, and is a subscription-based kind of business model. Some of the use cases right now, obviously for one, it will be gaming, creating all these very realistic or very futuristic graphics. Other use cases are architecture, engineering, and movies and entertainment. In terms of their Operate segment, it's more monetization. So they help developers because as you know, a lot of their games right now are freemium in terms of their business model. So it's free to play, but there is the premium kind of payment section, so you can pay more money for more access. And one of the things that the Operate segment helps to do is it helps to monetize these games in platform, so that developers can get more out of it. So in terms of Operate, it's more long tail revenue because as users play the game, for like 5-10 years, the developers will just keep using the service, and it's a per usage charge. And so the Unity will just keep charging them for each time they use it. Non-gaming revenue is at 40%, which we expect to continue increasing, especially as use cases for different verticals increase, so especially outside of gaming. Right now, the key clients are automobile clients, so like Mercedes-Benz, Volkswagen, and Hyundai. In terms of competition, Unity really dominates in this space. They have about 72% market share. What they expect moving forward is that they expect there to be a significant growth in interactive real-time 3D content on the internet. So they estimate this is about 2-3% right now and could rise to 50% moving forward. So that's all for Unity, and for me, I'll pass my time on to Max for PropertyGuru. Thank you.
Thanks, John. So for PropertyGuru, they announced their results for the second quarter of 2022 last week. The revenue grew by 44% year-on-year to 33 million Sing dollars, where almost all of it is attributed to their marketplaces segment. It also achieved a positive adjusted EBITDA of $3 million for the quarter. Singapore remains as the top performing market for PropertyGuru, where it generates more than half of its revenue. The company is currently keeping their eyes open for attractive M&A opportunities that can complement their current product offerings, especially for the fintech and data services segment, because they believe it has great potential. The management, because of the positive results for the past 2 quarters and of course the recent quarters, the management affirmed their outlook for the full year 2022, where they project to achieve a 44% year-on-year revenue growth and to return to positive adjusted EBITDA. Next slide, please. So moving on, I have another Phillip on the ground on mental health, which was one of our speakers in our webinars last week. Mental health was previously known as Metal Component Engineering, and the company is currently trying to make the transition into the healthcare sector. Its stock is listed in the SGX, and the closing price on Friday was at 3 cents with a market cap of around $18.5 million. The company recorded a revenue of 18.7 million for the first half of 2022, which was 7.7% decrease year-on-year with an adjusted EBITDA of negative 0.48 million. It is hoping to hop onto the growing digital medicine market in the region, which was mainly boosted by the pandemic. The company, Metal Health, has 2 main operating segments, which the first one being the metal operations, which where the company provides various engineering services such as precision stamping, surface coating, and assembly, to name a few. The other segment, which is healthcare, provides primary and home care services while operating a GP clinic in Singapore, and a central pharmacy, e-pharmacy, as well as infrastructure as a service model. For the growth strategy, the management is currently aiming to increase their product offerings and is also looking to focus on the current ASEAN market first before planning to expand further. Next slide, please. So last one from me. We also hosted audience analytics in our webinar last week. So we're doing Phillip on the ground. Audience analytics is basically a business assessment company, which I'll elaborate more later. Its stock is trading at 22 cents with a market cap of 37 million Sing dollars. The company reported $1.9 million of revenue in first half of 2022 with a net profit of $62,000. Audience's biggest segment is the business assessment and recognition. It charges fees to companies who wish to participate in the assessment, and another optional publicity fee should the nominee company wins the award. The exhibition segment is the second largest one, where audience organizes large-scale exhibitions and it earns revenue by charging fees on booth renting. Lastly, the business media segment is a B2B digital and print media publications, where they mainly focus on magazines, and it earns revenue by charging advertising fees. For their growth strategy, the management is aiming to replicate the success of its best-selling product, which is the HR Asia Awards, to all of its products, and they hope that by doing this, they can get a stronger presence in the current market that they are operating in. Now I'll hand over the presentation to Terence.
Thanks, Max. City Developments reported first half 22 results that was lifted by its hospitality segment and the investment properties. So in terms of positives, all 3 core segments improved. Residential sales were comparable with the first half 2022, while hotel operations globally also improved. Its investment properties were resilient, with office and retail portfolio recording strong occupancy in the first half of 2022. So if you look at the table here on your left-hand side, you can see the gross profits margin the GP margins expanding to 40% from 35%. And this was driven mainly by the improvements in the hospitality segment. Next, the hotel segment's first half 22 PATMI was ahead of our expectations at 60% of our full year 22 forecast. RevPAR surged 110% on a year-on-year basis, with average room rates up 53%. Similar with the last first half results, the US and Europe continued to lead the travel recovery. Next, the group remains on track for its AUM target of US $5 billion by 2023. The AUM target of 5 billion remains an integral part of the group's transformational strategy. Its current AUM of it has a current AUM of US $2.9 billion, and we believe that one way it can boost its AUM target is to inject its proposed listing of its UK commercial REIT into the private fund to boost AUM. So some of you may recall that CDL previously, they were looking to list the UK commercial REIT, but management noted that because of challenging market conditions, they cannot proceed with the listing of the commercial REIT. So one way that they can go about this is to inject the UK commercial REIT into the private fund. So that will also push them closer to their AUM target, which they hope to achieve by next year. Last but not least, the 12 cents of special dividends, which they declared, came as a surprise to us also. The management also announced that they would consider implementing a share buyback program to further narrow the discount between their current share price and the RNAV. The surprise came because in the first half of 2021, they only announced a 3 cents of interim dividend. And then when we look at the dividends that they announced pre-COVID, it was about 6 cents. So the 12 cents is a welcome surprise. With that in mind, we revised our full year 22 dividend forecast to about 24 cents. In our next slide, one negative, however, is the replenishment of land banks is expected to slow as land bank costs have surged. Having said that, management noted that because of their strong land bank in Singapore, they have about 2,500 units. This allows them to not rush to replenish their land bank sites. It allows for more conservative bidding going forward. So in terms of the outlook, they have a cumulative launch pipeline of 1,931 units with the next launch Copen Grand at Tengah Garden Walk. It is an EC with 639 units, and this is targeted for the fourth quarter of 2022. Next, the strategic review of its global hospitality portfolio, mainly is after its acquisition of Millennium and Copthorne MNC, will also reduce its RNAV gap with the price. So recall that in the first half of 2022, they actually disposed of the MNC Korean property, and that yielded them a strong gain on the disposal, which is one reason for the special dividends that they announced. So in terms of recommendation, we continue to call for accumulate. We downgrade our recommendation from buy to accumulate with a lower RNAV target price of $8.86, previously $9.19. This as we raise borrowing costs slightly for FY22 and FY23, along with lower recognitions for its residential projects. So we raise borrowing costs, even though what management say is borrowings costs actually, the margins for the borrowings have actually remained the same, but the base rate has increased. So the borrowing cost is expected to rise in the next 2 years. So with that, we downgrade to accumulate. So that's all for me for city developments. I'll now hand over the time to Zin.
Thank you, Terence. So now I'll be covering the technical power segment. So for this week, we are covering technical analysis for 2 stocks. So the first one I'll be covering is Home Depot. So for this, we have a technical buy at $310.60. The stop loss can be placed at $292. You can consider to take profits at $350 and $375. The stock last closed at $298.10 on Friday. For this, we believe that retest of the immediate support area at 303 to 318 is actually possible before the price continues to edge higher. This is because there was a neckline breakout of an inverted head and shoulders pattern form at $300.10 and at $300.60, which points towards a bullish upside. Also, the Ichimoku bullish crossover seen where the conversion line cross over the baseline also provides a bullish signal. So we believe that price could reach the first resistance zone at $338 to $350 before it heads towards the next resistance zone at $365 to $375. So moving on, the next stock I'll be covering is Yangzijiang Shipbuilding. For this, we have a technical buy at 95 cents. The stop loss can be placed at 92 cents with take profit level at 99 cents and $1.03. The stock last closed at 97 cents on Friday. For this, we also think that a retest of the immediate support at 94 to 95 cents is possible before the stock continues to edge higher. This is because price has been forming a series of higher lows while being supported by an ascending triangle support, trendline support to form an potential ascending triangle pattern, which is a bullish signal. Also, a 20-day moving average bullish crossover seen after the breakout of a downtrend channel is also bullish. Price is also supported by the 20-day moving average with bullish rejection candles along the way. So we believe that price could reach the first resistance zone at 97.5 cents to 99 cents before it heads towards the next resistance zone at $1.01 to $1.03. So that's all from me from the technical analysis segment. I'll be passing my time to Paul to cover on the remaining stocks and Singapore Weekly.
Thanks, Zin. So we move on to SingTel's first quarter update, the currency drag this quarter. This is when we say update, basically there's no full set of results. It's just some key financials that they provide. Next slide, and there's no briefing too. So in terms of the results, the first bullet point on the right, the results was within expectations. And the biggest hit, despite the big headwinds they had, so because Australian dollar was weaker by 4 percentage points, which is huge. That's why you saw Australian Optus is usually at the Australian consumer. The other currency headwind they face was the 6% weaker Thai baht and also 6% weaker peso. You won't see this, but you probably see this in the regional associates PAT line, but not on the table on the left. So in terms of the positive, I think we saw the Singapore consumer was up 11%. It's a recovery. We think roaming revenue has started to help. And also, but only drag was their pay TV was weak, almost down 14%. And also Australia was strong. If you exclude the NBN, so NBN is a one-off payment that they get because in Australia, all the broadband players have to shift to fiber, and then they get compensation. So all of SingTel customers have to move to fiber. So as a result of that, they were being compensated. So that's why you got this one-off. So we have to strip the NBN to get the actual performance in Australia. The negative is NCS. Why we highlight NCS is because SingTel, in the past, NCS was part of the group's Singapore enterprise. So basically, they provide IT services to companies, but they separated out because they wanted to eventually do a separate listing. But I guess not going to be easy since the earnings is still so weak. In terms of the outlook, we still think SingTel is on track for recovery. The recovery will be mainly from their mobile operations. So the reopening of borders, will, like highlighted before, will help roaming revenue for Singapore and Australia. It will also not need just the consumer, because in the enterprise, they also have mobile. So that means you sell mobile operations to corporate customers. So that will also benefit from the reopening of borders and roaming. The second thing is that the improvement in emerging market economy after the lockdown will also help in the mobile business, prepaid, which is mainly a bit more discretionary, because in these emerging markets, you have to, it's like you pay as you use style of mobile service. It's not a monthly plan. So as your income recovers, you will tend to spend more. The third reason is India. So India has seen a very strong rebound. If you look at the table on the left under Bharti, you can see there's a fourfold jump in profits. So what has happened is that in India used to be maybe 10 mobile operators, competition was everywhere. Then it dropped to 3 and virtually dropped to 2.5 because the third player balance sheet is very weak. They may not even be bidding for 5G license. So the improvement competitiveness in India plus pricing power will help the ARPU and profitability in India. And also more of the customers in India are moving to 4G. So that will also improve the ARPU and because they use more data and so forth. We maintain our accumulate, there's no change, a bit of movement in our numbers just for the exceptional gain they had. If you notice our target price, sum of SOTP means sum of the parts. That means, because SingTel has so many parts as Singapore, consumer, Optus, India. So we just kind of put a separate value for each one. Then you get the sum of the parts. But you'll notice that most of the valuations, the $1.15 is actually Singapore and Australia. So Singapore actually is very small part of the whole SingTel group in terms of the valuations. The big one, the 190 you see actually comes from the associates. So the market price, the share price of the associates is one of the big drivers or barometers for the valuations. Next slide. So the other big news for SingTel was the disposal of Bharti. So let me just explain a little bit. So SingTel owns Bharti Airtel, which is the listed arm. If you look at the table on the left, before the percentage stake, so they own it. They own it through Bharti Telecom. So Bharti Telecom is the biggest shareholder of Airtel, the Listco. So I know it's very confusing. So the other way SingTel owns Bharti Airtel is through the Pastel Limited, which is 13.9. So what they did was Pastel sold to Bharti Telecom, okay. So as a result of that, they sold 3% stake to Bharti Telecom, and they generated 2 billion of cash. The effective sale is only 1% because they still own Bharti Telecom, yeah. And the gain gave them like 600 million. So we view this positively. Number one, we view this positively, because there's possibility of a special dividend. And also, all of us, when we do a valuation for SingTel, when it comes to listed entity, we always put a discount, which is rightly so, because share price is very volatile. And also, if you really want to buy, you can always just go straight to the Listco. So that's why there's always a bit of discount. So this will at least just reflect that they actually can monetize, and the discount, although we will still keep it, but the discount they can actually the discount may not be that high, that may not be warranted, but I think most of us still keep it because they still have such a large stake in Airtel. The second, even more important announcement was that Bharti Enterprise. So again, very confusing. Bharti Enterprise and SingTel have a share in Bharti Telecom, which is the big shareholder of Airtel. So Bharti Enterprise said that they want to equalize their stake in Airtel. So what it means is that if you look at the box in red, so right now SingTel has a 29.7% stake in Bharti Airtel. Bharti Enterprise has a 19.6%. So what they're trying to say is that they want to equalize, they want to match the same amount of stake with SingTel. So what it means is also that in future, maybe not so soon, but they would also look to sell more Bharti Airtel to Bharti Enterprise. Okay, the difference is 10%, but maybe another 3%, because a bit more complex here. But Suni, one of the CEO of Bharti Telecom, Bharti Enterprise also has some shares. So, but anyway, directionally, SingTel can still tap on this and sell more shares if they wish. I mean, that's the key point. So this is another catalyst for them. Next slide. The next one is Hyphens Pharma. Next slide. So Hyphens Pharma, they have two main business. I mean, Ocean Health, most of us know as the vitamins. Ceradan, maybe some of us will know, and they call proprietary brands. The other part is specialty pharma. So specialty pharma basically means they sell prescribed drugs or other items mainly to doctors. So only doctors are their customers. So that's their strength. Because Hyphens Pharma strength is they sell direct to doctors too. So some of them is like when you use X-ray, you need to inject the ink. So these are some of their products. So the results was above expectations, partly because they make this new acquisition also in specialty pharma called Novem. So I think the positive was that the Novem did very well. If you exclude the Novem, you can see that the revenue for the organic business was up 12%. The negative was they are going to cease distribution of biosensor. I think some of us, you may know, because it was listed here. It's listed. I'm not sure if it's still listed, but it was listed in Singapore. So they're just going to stop. They're going to stop the contribution. Maybe probably the agreement didn't work out and so forth because it's a distributorship. In terms of the outlook, we think Hyphens Pharma is a really long-term stock. I mean, this stock will not, the earnings will not jump organically. The usual 30, 40. Don't expect that. It will probably be a high single-digit or low double-digit growth type of business because. But the journey for them is they want to build the proprietary brand. So they're moving their proprietary, Ocean Health and so forth, through the region, Malaysia, Vietnam, and then they will take on more specialty pharma products. We maintain our earnings because the other thing they're trying to do is they're trying to set up a new. They themselves call it's like a Shopee for doctors. So they're trying to build a platform, a website, another name for it, where doctors will be in this platform. Drug companies will be also in this platform. They already have some of it. It's under the table on the left. You see this thing called Medical Hypermart. But for that, basically all the clinics will come to Hyphens and buy whatever drugs, I mean, any other medical consumables they buy from them. But they want to bring it into the internet platform and try to get more and more people coming into this platform, which is including doctors and other drug companies which want to sell to doctors. Then you come to my platform. But of course, the problem with this is that in the near term, you need to take on costs. You need to build the platform, improve. So as a result of that, we won't change our earnings, although it was better than expected, because they're going to take on some of these costs to build this platform. Next slide. Next slide. So we move on to our weekly. In terms of the Singapore macro numbers, we had visitor arrivals. So visitor arrivals was very strong. It's like 38 times. I mean, if you want to do a count, 38 times higher than last year. Of course, last year was also close. So in terms of pre-pandemic, it's about 40% of pre-pandemic. But again, trajectory or direction-wise, this is very positive for the Singapore economy. Because pre-pandemic 2019, Singapore 5% of our GDP comes from tourism. So even if you add 1 or 2 percentage points, so this is also a very positive development, that tourism coming back, and it will help at least support the economy. Industrial production is a bit slowing down, manufacturing activity. Core inflation, the headline inflation in Singapore was 7%. But the core, which is what the MAS uses to determine whether they want to move exchange rates or their monetary policy. So core means they will exclude, because fuel and transport is very volatile, so they exclude it. And it was above, it was 4.8. The significance of this is above their projection. So this is the second month, it's above their 3 to 4% projection. So by October, they will probably tighten. Actually, all this tightening doesn't really mean much for the equity market, but again, probably it will be all over the news. They probably tighten by raising the slope of the curve, their exchange rate curve. In terms of the US, there was quite a bit of the news. I think we all saw the power news. But we think the core PCE, so core PCE is another inflation, is apart from CPI, they got this thing called PCE, personal consumption expenditure. But this is the gauge which the Federal Reserve used to determine. And whenever the Federal Reserve says we want to hit 2% inflation target, they're actually referring to this PCE. So the good news is that month on month, year on year is down, but it's one thing. But month on month, the more critical thing is that it was down, it was flat. So this is a very positive, because it means that this is the slowest month-on-month move. Because before you get the year-on-year 2% target, the month-on-month has to creep down. So what we think is that if you mathematically, you could see the Fed hitting the target maybe 7-8 months or maybe the third quarter of next year. So there's a good chance if inflation continues to slow the core, that the target could be met. So this is positive. We'll explain a bit later. So some of the comments, I think we all saw, the news by Powell. I think everybody keeps on talking about this thing. He's looking to bring pain to household business. But anyway, they do not want to. They caution against prematurely loosening. And the other FOMC members say that the problem is they're not sure long term how inflation will settle, but they're just looking at the near term. So most of them think that by end of this year, the Fed interest rate will settle around 3.75 to 4. So currently it's about 2.25 to 2.5. So what it means that you can expect another 150 basis points in increase in interest rates So the next 3 Fed meetings, you can expect 50 basis points. 50 basis points means 0.5%. 100 basis means 1 percentage point. So you can expect more interest rate coming up in the next 3 Fed meetings. Another FOMC member also said by early next year or end of this year, they want at least 4%. So the market actually thought it was only 3 point something. So I think that's why there was a bit of shake-up. So in terms of our tactical views, we still think there's rally, although the market is corrected, but we think there can be a short-term rally because the view would be that inflation will be peaking. Because we think that, like we mentioned earlier, a 2% target is even possible in the next 6 to 12, depending where the month-on-month is. But what it means is that, tactically, what it means that the market will see that the tail risk of the Fed raising above 4, maybe 5% or 6% is off the table because inflation already peaked. But the 4% is definite. So why the market reacted negatively? We think the power was just pivoting earlier from his earlier pivot. So what we mean was that, in July meeting, Powell said that there's possibility we are near the neutral rate. So he hinted wrongly, I guess, that the interest rates might be slowing down. So I think now this speech that he made was just to tell everybody, no, interest rates will continue to climb. So the impact will be, of course, REITs will be the one that will be negatively impacted because you think interest rates are going to climb the next another 150 basis points. So I think, so these are a lot of negative headwinds for REITs in general. In terms of our events, we will have a Fraser Hospitality, but this will be only for the TRs. Then we have on Wednesday we have Halcyon, the rubber glove plantation and processing company. So feel free to register for that if you have the time. Next slide. So this is my last slide. I'll just run through. So Cod Life had a briefing. So Cod Life, what they do is they do cord blood banking. That means they store the cord blood for newborns. The profit was down almost 24%. So the problem they have is that for this product, Cod Life, cord banking is essentially a marketing product because the clinical trials have not supported it going mainstream. So when the pandemic happened, the hospitals told them because in this business you need a lot of face-to-face sales and marketing to expecting mothers. So when the pandemic happened, so of course the hospitals will say, tell the salespeople, please don't come in and stay in my clinic since we are having a pandemic. So they had less FaceTime engagement with expecting mothers. Because usually you need to convince mothers to take up this. So in terms of the science, cord banking started 21 years. There was a lot of hype. It was considered like a standard practice, but since then, clinical trials has been patchy. So there's been a bit of autism, regenerative treatment, but there hasn't really been like hard mainstream use of this. So as a result of that, when you go to the outlook, we think this is like similar to marketing insurance service, and that's about it. And there's competition in this business because there's in Singapore there's a public Cod Life, Cod Blood, and there's also 3 more private ones. Okay, I think we can move on to Q&A. Yeah.
Yeah, so I'll take some of the questions in the queue. Hi Terence, what is the borrowing cost for CDL? So as of first half of 2022, their average borrowing cost is 1.9%. So this is already up about 20 basis points from the full year 21, and they expect this to continue to increase to maybe about 2.2 to 1.3 for full year 22. Yeah, sorry for the technical issue, but that's all from me. I'll hand the time back to the rest of my team.
Okay, let me just try to take on before we hand over to the technical part. Is there any reason for Civil Axis drop? There isn't anything. I think they will release their results by today, so we are still positive on this stock. We don't see anything, any negative news. I think it's just, I guess, the whole market but the results will be coming up after the market close. I think from the last meeting we had with them, the upcycle is still there. I think after 2 years of not spending, there's a bit of pent-up demand by the banks to spend on IT, and hopefully they can get 1 or 2 big projects, because they're already getting some of it in the cloud. Their new product, Mobius, which is a cloud banking software, so that is also doing well. But we will share more after the briefing and results that comes up by today. But we still like it. I mean, yeah, in a nutshell. Any views on ComfortDelGro here? I think no real change. Oh, sorry, I thought the camera's on. For us, I think no real change for me in terms of ComfortDelGro. We still like it. The recovery, the rebound is still occurring. Again, for just to refresh, for the only weakness that will be on the bus part, because I think they already figured out, I think, a few months ago. But for the taxi takings will be strong. It could be even higher than pre-pandemic. Some of the commentary that was made. Number 2, although the problem for taxi right now is the fleet is down, and also they froze they're giving a 15% rebate for taxis. But on the flip side, this will end in September, and also they're getting some commissions from the booking fees. So that will help. My other point for taxi, then of course the other thing is the rail business will perform well, because that one is pure volume. I think everyone coming back to work, so that will just be a big growth driver. But the main point for Comfort is that every dollar revenue they collect, I think maybe 40% goes to the bottom line, because it's a very high fixed cost business. So we got no change in our view for ComfortDelGro. By the way, we'll be having them for our poems, for our webinar. So if you do have time, it's already on the poems website on the 29th of September. I know it's very far away, but anyway, just for anyone who wants to listen to them on the 29th. So they rarely do a webinar with retail. But they're very kindly always do it once a year with us. So do sign up for that if you have the time. Any comments on SingPost? Terence, you want to help out on that?
Yeah, so for SingPost, based on their recent results announcement, their core business segment, the mail segment, is actually it's a circular trend. It continues to be weak, so no surprise on that part. The part that they are really trying to actively push up is the freight and logistics segment, because they see that as the future trend for the company. But that segment it continues to be hindered by higher costs and weaker demand as well. So you see that segment lagging. So overall, to summarize, their first half 2022 results is a little bit of a disappointment for SingPost. And then what time frame I think that's a second question, what time frame to see an uptrend? So they are doing a lot of investments, near-term investments to beef up their logistics capabilities, and that could take another 1.5 years. So with that front loading of the cost, the dividends and the earnings of the company will consequently be affected. So we don't have a call on SingPost, but the catalyst for rebound is unlikely in the near term. Yeah, I think that's all. I'll hand back to Paul.
Yeah, let me just top up on what Terence just said. So for SingPost, I mean, excluding the Australian business, there's of course mail business here, which is like which is delivering letters. So we all know that's not happening. they might get some short-term bounce, maybe when there's a promotion, more marketing, maybe courts might send you more mail or catalog mail. But that business, like he said, is on a secular decline. The only thing that can revive mail is really if there's a repricing. So the last time they had it was a couple of years. That was the only time I think the share price took a bounce because when they raised the postage. The second business, which is delivery of parcels, that is the fastest growing. I mean, all of us keep on ordering stuff. So obviously that is going to be a good business. But the problem is that the mailbox isn't catered for that. So that's why they, like Terence mentioned, they need to invest. They need to revamp the whole way, the whole mailbox in all our apartments or condos, because it's too small to take on. So that will take a multiple year investment. So because of that, that part of the business will still be weak. The third part of the business is e-commerce delivery. So what they do is, I think again, some of you might have heard us mention. So just to give a simple example. So if you have a parcel in China, you want to send to Europe, the obvious thing is just send to Europe directly, but apparently it gets cheaper if you send it down to Singapore. Then Singapore will combine it with all the parcels from Southeast Asia, then you send it to Europe. So that business was totally, I wouldn't say annihilated, but it was totally badly affected because of the whole lockdown. There wasn't enough flights. So in the end, people might as well just send it direct to China. So that business, that was the other part of the business. But again, this company is a bit of it takes some time. You need a lot of investment. So until they can transition from mail to parcel, then I think then that will be the time where maybe earnings can bounce back up more strongly. But I'm not sure how long, but I believe that is thematically what they're trying to do. Last Friday, Dow Jones dropped more than 3%. What is Powell trying to say? Time to accumulate more or sell? Your thoughts, please. Okay, I think Powell was just trying to say, don't think interest rates won't be increasing, because when you look at the futures market, there's a futures market on this Fed. They were thinking next year interest rates were going to come down. So basically, he just tell you no way. Interest rates will be high. It will inflict some pain. That means the Federal Reserve is willing to bear some slowdown in the economy. I think most important was he was trying to rectify what he said, because when he said that interest rates might be coming down, it was more like a Q&A session. So maybe it might have been a slip up by him to say that they are near the neutral rate and they need to come down. So for me, my own thoughts is we are a bit more aggressive. I think there could be a time to accumulate, because we think the next inflation reading coming, I think maybe 2 weeks time, not this week, I think maybe the following week, we think they could show that inflation is still coming off. So if you're doing my own thoughts, if you're doing for us, our short-term view is that we are making a bet that inflation is coming off because commodity price all collapse, and even cost inflation is coming down. So we think that will be a signal for the market to just say that, hey, inflation is peaking, although the Fed has committed to raise rates, but it will just stay there. It won't take off the tail risk that interest rates are going to climb to 4 or 5%. Again, these are all very short-term kind of views. Yeah, not sure if that helps. Any possibility for SingPost to divest SPC? I really not clear. I mean, yeah, sorry. Any update on Del Monte? There hasn't been any news, but we only can say that now Del Monte is a consumer staple, so they won't be so affected by this. And when the economy weakens and when there's high inflation, there'll be less dining outside. Now people will consume more, hate to say this, but more affordable meals like canned food, which is what Del Monte does. That's probably the most affordable meal you can have. Is like canned vegetables or canned corn. So if there is a downshift in consumer demand to more value products, technically it should help Del Monte in the US. Okay, I think Zain, we hand it to you first before we take on the rest. Thanks.
Okay, thanks, Paul. So I'll start covering some of the technical questions. So the first one I see is Xpeng. Okay. So for this stock, actually went down after earnings. Then now currently we see that there's a double bottom.
I don't see the screen.
Sorry?
The screen. I don't see the screen. Sorry, maybe it's only me. It's not on the screen.
Oh, okay, wait. Let me try again.
Thanks.
Okay, okay. Can you all see my screen now?
Yes, thanks.
Okay, so okay, as I mentioned, there was a currently we are touching the swing low form in May this year. March after results. So possibly I think we could be seeing some indecision here as there might be some buying and selling pressure based on like the results and technical wise. So we might see some short-term sideways range. But overall trend is still bearish, yeah, because of the lower highs and lower lows. So the next question I move on to is PJC. Okay, for this stock, it looks like there's a breakdown and a retest of a key level. Draw it. So over here, there was a previous support area around 170s to 180s, and then we actually broke down a bit, and now we are currently seeing a retest of this key level. So the previous demand here could become a supply region here. So the stock could face some resistance over here, and resistance upwards could also be found at around 190s over here. Then the short-term support is around here at around 150s to 160. Yeah. And then overall trend is also bearish. Okay, I'll move on to STI. Okay, so for STI, I think that we are currently on a down wave. So previously, after we formed a double top, then there was a big strong move downwards until the middle of June, and then subsequently we started to have a short-term relief rally until the middle of August, where we hit around the 61.8 Fibonacci retracement level over here at around 3,300 points. Then currently we're moving downwards again, as seen by this lower high form over here. So I think that we could be moving downwards, also complemented by the bearish signal in the MACD and the RSI. Okay, then for support wise, we could be seeing it nearer to around this region, around I think the 3,150 here will be a quite strong support, because it was a strong resistance over here to the region of maybe around 3,200. Yeah. So we could be seeing some retest of this region. Okay, I'll move on to SingTel. Okay, for this stock, it's currently, there was a trend reversal, as previously there was a downtrend, and then after we broke out of this downtrend resistance line here, we can see the stock forming an uptrend over here. So it's in a nice little uptrend, and then before that, I counted some resistance at this key level around around the 164 to 168 region. There's a resistance level here. So recently the stock tapped to this region, and there was also a high volume day. And then we could be seeing some selling pressure over here. So short term wise is still in a nice uptrend, and we could find support firstly around 158 to 160 region over here. Then the next support area could be found in this region of 152 to 156 over here. Yes. So then if we manages to break the resistance thereafter, we could be seeing the stock hit to maybe around 175 to 178. Was a previous key level over here. Okay, next I'll cover some of the REITs question being asked. So first one I'll be doing is iREIT. So for this stock, it's bearish. After the COVID crash, it rebounded and then it moved in a sideways for a very long period. And then we are currently seeing the stock slowly starting to edge down again after and it's currently in this key level over here. Around the key level support is around 55 cents to around 58 cents. So if we do break down, then I think the next support level could be found around 46 cents to 49 cents over here. Chart wise is bearish. So next one I'll cover is Daiwa House. Okay, for this stock, it's also bearish. It's an IPO stock last year. So after the initial sideways, there was a ramp up, and then it was turned out to be a false breakout over here, and we back down. So looks the trend is also bearish. You can see the lower highs for being formed and the lower lows being formed over here. I feel that we could be coming back to this support region at around 64 cents, 64 cents to maybe 67 cents over here. Yeah. So then the short-term resistance, it's here at around 75 cents to around 77 cents. So we could be possibly seeing a sideways movement for now. The last of which is ESR REIT. Okay, so for this, it was a bullish movement last year. You can see it's a nice uptrend channel, and we actually broke off it in around March this year by forming the series of lower highs and lower lows being formed. So currently it's in a sideways direction. So short-term wise, I feel that the key resistance could be found around 43 cents to 45 cents. There's a lot of supply formed around January to April in this region this year. And then the short-term support is likely to be around 39 cents to around 40 cents, also a psychological support level. And then if we continue to move lower, then the next lower swing low will be around 36 cents to 37.5 cents over here. Yeah. The general trend is bearish. Okay, next one is Samudera. So for this stock, recently there was a big rally, and then we are currently seeing a pullback. So for now, around mid-August, there was a retest of this support. So the retest of this swing low formed at around 96 cents. And then afterwards, we met some resistance close to the around $1.04 to $1.05 region over here. Yeah, and we actually failed to even test this higher resistance area of 110. So it looks like the stock could actually come down to test this support region again, form around 94.5 cents to 96 cents. Then if this level doesn't hold, right, then we could see the stock come to the next support region, which could be found possibly at 84 cents to 88 cents. The short-term wise, it could be turning from bullish to bearish, as you can see the lower high being formed here. So if this 104 to 110 is not being taken out and continue to try to break above to try to test this higher resistance at around 126, 127, right? Then the trend could be shifting from a bullish to a bearish trend. Okay, I'll cover on Silver Lake next. Okay, so for this, it looks like it could be forming a short-term top for now. As you can see, there was a bullish trend over here, and then currently we are experiencing a pullback. So for this, the short-term demand zone will probably be around 34 cents to around 38 cents over here. So we are actually coming into this region. So, and then the resistance wise could be around 39 cents to around 41 cents over here. Then the higher resistance zone is around the swing high form at 43 cents to 44 cents over here. And then the indicator wise is also bearish. You can see that MACD is currently moving down. Yeah. Okay, I'll do on startup next. Okay, overall trend is actually in a massive sideways formation. So the key resistance area is around 135 to 140. This zone has been tested twice in the past 2 years. Actually, then didn't break out of it. And then support wise, we are likely to see it at this region of 118 to around 121 region. So actually we are coming into it quite now. So we could be possibly testing this support region and maybe continuing the sideways direction. Intermediate supply is around 127 to possibly 130, 131 around this region. And if this support region doesn't hold, right, then we could come down to this next swing low at around 115. Yeah. Okay, next, I'll cover the US tech stocks. So for Alphabet, it looks like it can't break out of a big sideways resistance. So the stock actually there's this resistance area around 170, 118 to 122. So recently it came out to this resistance area form and then it started to trade downwards again. So likely we are likely to see it as we test this support region at around 104 to 107 again. Yeah. Trend wise is also bearish this year with lower highs and lower lows. So actually, if this support region doesn't hold, right, this could be a bear flag formation because of this strong downwards move previously. And then the next support region could be found around the 100 psychological level. And then the previous support region was also found around here. Yeah. And next, I'll move on to Microsoft. So for Microsoft, this year also downtrend, but it actually looks like it could be stronger than Google because there's actually breakout of this downtrend, but then on Friday, because of the broad market decline, it actually closed back downwards. So we need to see whether it can move back upwards in the recent days ahead. But for this stock, the current, let's see whether the previous resistance area formed around 267, sorry, to around 277, the $10 range. So there was a previous demand level here, and then we turn into a resistance zone over here. So it's important to see whether this level can hold before the stock can actually has a chance to trade higher. And then support wise, I think there's a support trend line over here also. So then for horizontal support, it could be found at probably 247 to 250, 251 region over here. Then the next week, if the stock continue, if it successfully breaks out, right, and we could possibly see the stock hit to around 300 to 320, another major resistance zone over here. And the last of the tech giants will be Meta. So this stock has generally been in a sideways direction after the crash early this year. So for this, the demand zone will be at 155 to 160 region. So we are likely to come into this region and see how the price reacts. And then short-term resistance wise, it's around close to 178 to 190, the lower end of 190 around here. So it is important to see whether this support region holds and whether it can break out this resistance in time to come because it can be dangerous because the downwards trend is pretty strong, and this could be a bear flag formation. So if this doesn't break out, right, we could be seeing the stock head lower to the previous historical support levels at around 125 to 140s, formed around 2018 and 2020. Okay, I see anchor analysis question on Marco Polo Marine as well. So for this stock is generally it's in a bullish formation. You can see there's a higher highs and higher lows being formed. Recently it looks like it tapped to a resistance area, short-term resistance area, based on the trend line channel at around 37 cents. The stock actually went up to the high of 3.9 cents. Sorry. Looks like there's a chance that you could be retesting this previous resistance area around 32 to 3.2 to 3.4 cents. Yeah, and there was actually a breakout of this consolidating triangle. So it's likely to hit higher, but possibly it could be forming a pullback for now. Yeah. So the resistance area is formed around here, 3.6 cents to 3.9 cents. Then if the stock move higher afterwards, right, based on the historical level, we can see resistance at around 4.2 to 4.3 cents formed in 2018. Yeah. So that could be the next level to watch out. But the chart wise, it looks good. Yeah. Okay, I'll take Comfort Delgro next. So for this chart wise it looks like it's transitioning from a downtrend channel to more of a sideways pattern over here. So we could be seeing the resistance is probably around the region of around 148 to 150 to 153. There's a lot of supply created in late March to April and early May this year. And then for support wise, we could see around the lower end is 133, and then the higher end is around 138. So I think we could be coming after we see all the rejection candles at the resistance area over here, we could be seeing the stock likely to come over to test the demand level again around 153 to 138, as seen in June, late June this year. But overall, it looks like it's probably gonna trade sideways for now. Okay, I see a question on Yangzijiang financial. So for this, it looks like it's in a bearish trend. I can see from the low highs and lower lows. Recently, after the results, actually broke down the key level at 39 cents, key support level. And then afterwards, we retested it, but there was a rejection candle at 40 cents over here. So short-term wise, the resistance could be found around 39 cents to around 41.5 cents. And then the swing low here at 35 cents to 36 cents to provide some level of support. Maybe we could see the stock trade sideways if the support level region holds. If not, we could be seeing a lower low being formed over here. Okay, I'll move on to Apple. So for Apple, it looks like there's a huge supply region being formed around at high ends of 171, around 175 to 180 region over here. So the stock came out over here and then we actually moved down a little bit. So short-term support will be found at 160s to 164 over here. We're likely to come into it. And then the lower support region could be at around 140s to 150 over here. And then for technical indicators, there's actually a bearish crossover on the MACD and the RSI. So there's a possibility that there's a change of trend from bullish to bearish trend to no. Okay, then for Alibaba, it's changed from a downtrend, a big downtrend channel, to more of a sideways trend, similar to ComfortDelGro as mentioned earlier. So the short-term resistance, we could see it form at 96 to 102, 103. There was a rejection candle over here on last Friday. So we possibly could see retest the short-term support around 85 to 89, $90. If not, the lower end of the support region could be at around 77 to $82.
Okay, Zain, I think you prepare for the rest. Let us just try to finish off all the fundamentals on them. I'll just let you continue. Yeah, but you can just stay on this on your table. You don't have to change it. So unless those who posed the earlier question, not to let them wait too long. So let me just continue. Then we'll just hand it back to Zain on the technicals to finish it off. Hi Paul, any comments on the outlook for UG Healthcare? I think in general for all the glove makers, it's still going to be challenging, because the Chinese glove makers continue to press down prices. So the initial wave when China came in, firstly, the impression was nobody trusted the quality, but then it started to make headway with the clients. And then right now, Malaysian manufacturers are also adjusting their price to try and meet the Chinese glove maker prices. So this down cycle, although it won't come off anymore, but the prices are still weak. There hasn't been any recovery in the glove price as an industry. Let me run through the next question. Will US enter a recession? I think the problem I have is that the yield curve is inverted and is deeply inverted. So there's a very high chance, technically we're already in a recession. So there's a very high chance that the US will enter a recession. The typical definition based with wages and everything, probably in another 6 maybe middle of next year or end of next year. Based on just the yield curve inversion, that's always the best indicator of a upcoming recession. Any views on oil price? There's been talk of prices too low despite high demand. Yeah, I think my own thoughts is that the oil price has been a bit more suppressed because of the strategic petroleum reserve. I think it started in March, it's going on for the next 6 months. So every day, the US is selling about 1 million barrels a day. But if you look at the production levels in the US, it continues to be it is climbing, but still much. Number one, we think oil price will stay high, and maybe after the strategic petroleum, probably by October onwards, the prices could climb up more because number one, Europe will stop buying Russian oil, although it doesn't seem to affect Russian production. And number two, when you look at the capex by the oil majors hasn't really increased much. So there is no long-term solution to this high price. There's demand destruction, but demand destruction is usually very temporary in nature. I mean, after a while, you still need to use fuel and so forth. So there's no long-term solution. There's no increase in capex. And number three, another data point we use is also the shale producers drilled but uncompleted. So it's like they drill the hole, but they haven't produced, and that continues to come down. So it's like the inventory of production, inventory of wells they can tap on. So that is come off by several thousand. So we think oil price will still be high and might climb up in the later part of this year, especially if there's a colder than expected winter out of Europe. I mean, this is just yeah. The next one is where could we access the Fed funds future rate hikes? We get it off from Bloomberg data. I think this is a implied computation by Bloomberg. I don't think you can get it anywhere else. I'm not sure. There's but this one we got it from Bloomberg, so they will tell us what is the expected Fed funds interest rate in December in June and so forth. So, but we get it from Bloomberg. What's the impact of the Malaysian elections on the Singapore market? Of course, depending on G to G relationship, but I assume that is good with the current administrations. The other thing is that the common belief is that once the election is over, Malaysia would raise a lot, because there's a lot of price controls in Malaysia now. Maybe petrol, sugar, flour, all the essentials. So there's a worry that inflation will spike up in Malaysia after the elections. So indirectly, it might kind of affect a little bit that will cost more wage. The minimum wage might increase and so forth. Again, this is hard. It might have a little bit of impact on those Malaysian manufacturers because the cost of living will increase. Yeah, but in terms of the direct impact, I don't think there's any. What is your view on the Embarador business? Sorry, we're not really familiar, but we've asked Embarador to do a webinar with us, so we're just trying to get the exact date. So hopefully, if you have time, we can hear. I also want to hear because I don't really know what the business is. Any update on MM2? So far, nothing. I think they've been quite quiet. Sorry. Any update on Swiber judicial management? I really don't know. Sorry. Judicial management started in 2016 for Swiber, but the only thing we can tell you is that what we hear from the industry on all these risks that, of course, also affect Marco Polo Marine is that a lot of these risks, the question is what happened to all these risks that Swiber owns? I think a lot of them went to China. So what happened is that China is going through a major rollout of offshore wind. So there's going to be, I don't quote me the numbers, maybe a couple of 100 gigawatt of power. I'm not sure, I'm just pulling a number, but they need a lot of these AHTS to bring all the turbines out into the sea. Not supply, not the usual like all rigs, not supply, bring people in and out, but you need to carry all this equipment offshore to install. So that's why China bought a lot of the AHTS, which is what Marco Polo is doing. So because China's going to roll out a lot of offshore wind and gas. Offshore wind production. Okay, I think Terence, there's one for you, if you could help.
Yep, sure, Paul. Terence, any adjustment to Sembcorp Industries target price as the current price already exceeded your target price? Yeah, so our target price is about $3.27. Now it's about $3.39. So we will not be making any changes to the target price. So mainly because for second half of 2022, we expect the results to still be a little bit weaker than first half 2022, because first half they receive some one-off gains, which is some of their gas hedging contracts, which give them about $90 million gain. And then the USEP prices were also much higher in the first half of 2022. For July, the USEP prices were really about 10% lower than what it was, 10 to 12% lower than what the average price is for first half 2022. And then some of their gas powered plants like Sembcorp Cogen will actually be down for maintenance for about 45 days. So in our model, we just took them out for about 2 months, 60 days, for contingencies. And then there's another power plant in Myanmar that is also going to be down for, in India, they'll be down for about a month as well. So overall, these maintenance plants that are down will affect the top and bottom line that they'll be getting. So overall, the second half we expect to be slightly lower than their first half, and at the current valuation that we industry says is 1.2 times book, which we historically is already quite high. So that there could be a basis to increase the valuation multiple in the future if they can continuously grow their earnings. By this stage, I think we're comfortable with 1.2, which is historically already at a premium to what they used to trade at. Yep, I think that's all the questions for me. I'll hand back to Paul.
Okay, so thanks, Terence. So I'll just finish off these two last fundamental questions, then we will just send it to Zain, then we can end it. How do you see Chinese bank stock prices? Even PE, PB, dividend yield look good. Prices seem to be trending downwards. Any comment? Yeah, Chinese banks has always been more or less trading below book. Last time maybe 0.8, now it's 0.5. The yield has always been good. The results will be coming out on Monday. I think for me, I mean my own view, I think a more riskier approach because if the banks are going to recover, then property has to recover. So why not just buy the epicenter of this, which is property? So for me, I prefer to just buy the Chinese property names because you just want to trade the bounce up. So of course, you don't want to buy the Evergrande, the private. You want to buy the state-owned. So some of them are like China Overseas Land Investments, Corley. The other one is Poly Property, but I guess Corley will be the main. So the bet we are making is that China will relax. And again, we think it has already started to happen, relaxing some of the lending measures and start to relax some of the property restrictions. So for us, we take it a bit more extreme. We think if there's a bounce in China stocks, property has to move. So we just want to go direct to the China property rather than indirect to the banks. So this is my own, again, this is my own thoughts. I'm not a China property expert, but just for positioning wise, that would be my own way, I guess. Hi, Paul, could you comment, number one, the US new definition that is not a recession justifiable? And number two, if the Fed needs to increase the interest rates more than inflation rate effectively to lower inflation to normal. Yeah, okay, so there's really no definition on GDP, on recession. Recession is still compiled by this NBR. I think it's called, I've forgotten the name, but you don't blame them in a way because of the pandemic. So the so-called rule of thumb, the newsworthy definition of recession is 2 negative quarters. But because post-pandemic, you got a big bounce in the economy, then of course after the big bounce, you might get the big drop after that. So there could be this huge volatility inherent in GDP because inventory will bulk up, then inventory got wind down a bit because post-pandemic. So I think it can be justified to a certain extent because of this really anomaly, right? You shut down now that like the Singapore airport, you shut down, then you open up again, then after it will slow down, then you say, oh, there's a recession in the Singapore traffic. But it's because they close and up, and because they close and open, so everything will get like wild gyrations. So that one I think can be justified. But again, the definition is determined not just on that. I mean, they look at jobs and everything. But anyway, number two, in terms of the Fed, I think they need to raise, but it's going to be hard for them to do it like what they did in the 1990s or 80s. Again, my own views, because there's so much debt now in the economy. You try to push it too high, inflation is 8%. I can just imagine you try to push it to 7, 6, 7, though. I think the economy is just going to collapse because there's so much debt now in the system. And another reason why not to chase inflation is because inflation is very volatile. That means it's the Fed chasing oil price, and so hopefully they don't. They can also make. Hopefully they don't do it, because what if oil price can also come down? It's so volatile, commodity price, or even it might just stay sideways. Then what happens? Then inflation will actually come down. So I don't think they will push it to above inflation rate, because it's so volatile. But 4% is confirmed now. All the Fed officials already communicated strongly, and usually once they communicate that, they don't want to back it down, then it will cause a lot of volatility in the market. Because the purpose of telling us all that is so that you don't get surprised. So they will very likely stick to this 4% interest rate by end of this year. I'm not sure it helps, but any thanks. Thanks for waiting, Zain. So I will hand it over to you.
Okay, thanks, Paul. So I'll continue with the TA segment. So I'll start with the Hang Seng. So for Hang Seng, it's a big downtrend. Then currently, we are currently experiencing more like a sideways formation. So the resistance area is close to around 22.5K, 22.4 to 22.5K region. And then short-term support is around 19.2 thousand over here. As can see, these two swing lows being formed over here. Then yeah, so I think and also intermediates resistance zone could be in this area around 20.2, 20.3K to 20.9K. Yeah. Okay, so next one I'll be covering on Sembcorp Industries. Okay, so this stock has been a very strong bullish run this year. So so actually previously it broke out of this key resistance area around $3 to $3.10 region over here. So we are likely to see this previous resistance area become a area of support in time to come. And recently has made a very strong move to the high of 3.44 cents. And also I saw that it was actually the previous historical high over here at $3.45 was the historical high back in 2007. So there might be some resistance, short-term resistance at this region, but doesn't mean that we can't continue to break higher. If the momentum does continue, we could see resistance form around, it could take to some resistance along here, around maybe 370s to 380s, based on this trend line formation over here. Then short-term, very short-term support-wise will be around $3.16 to $3.25 over here, as formed because of this consolidation range form before the strong impulse move over here. Yeah. Next, Keppel Corp. So this stock is looking pretty good as well. So previously you can see there was a pretty strong resistance level formed at around $6.97, close to the $7 region. Rejected multiple times back in 2019, April 2022 this year. And then finally this in August, right, we've finally managed to form this higher low range at this previous resistance area, which is a good sign that price could actually be prepared to make a move higher. So the next resistance I see is around $7.30 in 2018, this swing high over here. And then if we continue to move higher, right, we could actually hit to around $8 to $8.30s over here, a 2018 price level. However, if this consolidation range fails, right, then the next support level is, the lowest support level is around 640s to maybe 650 over here. You can see like it was provided a strong level of support this year. Okay, Bank of America. So this stock was actually covered in our technical pulse, one of our technical pulse calls. So I was mentioned that the time I mentioned the stock is likely to come back to this support zone around the consolidation range from around $33 to 34.40 over here. So right now it looks like it's coming back over here, but I believe that the stock could actually move back upwards the higher resistance zone of around 42 to 44, and afterwards maybe around 48 to 50 over here. Because of the falling wedge pattern over here, right, we are likely to see that the downtrend actually change to a trend reversal to a bullish trend pattern over here, if provided that this support region actually holds. One is Agilent Technologies. Okay, so for this stock, it's also actually looking pretty good. There was a you can see there was a big downtrend formed since late 2021 until we broke out of it in July this year. And then firstly, there was a gap up after the earnings. Then we tagged to this strong resistance area around 140s to 148. Then we sold off. Then currently we are likely coming back into this support region, which is pretty strong around 123 to maybe 132, 33, another $10 range. So provided this support level can hold, right, we could actually be possibly seeing price retest this resistance area from after the results. And if longer term wise, if the trend continues to turn bullish, you could see resistance upwards around 160s to 165 region. Okay, next we have Keysight Technologies. So this stock also probably looks like a trend reversal pattern. So previously we have seen like this high, then we form a lower high, then suddenly we are and the lower lows form over here. And suddenly this around July this year, right, we saw this uptrend channel being formed. So it's likely that the trend has turned from downtrend to an uptrend. And the key support level to watch out for is around this region at around 144 to 150 over here, because the previous resistance zone and actually broke out of it, the stock made a move upwards. So after encountering some resistance at around the resistance at 165 to 180s over here, we actually coincides with the Fibonacci level of 61.8%. We could be seeing the stock hit, do some retracement to backtest this support region here before it actually moves higher. Yeah. Next will be Wilmar. So for Wilmar, the trend is actually bearish because of the lower highs being formed this year, from the peak in last year, February 2021. Okay, then the support wise, the strong support region is close to around the $4 mark. So then the resistance wise, we can see the strong resistance around 430. So after earnings, the stock actually went up. Then there was a huge rejection and sell off, big and a company with high volume. So we're likely to see the stock come back down to the $4 region, I guess, and it could be forming a sideway region of $4 to 430s. If it actually breaks down, then we might see the next support region being formed at around around the 380 region over here. So next I'll move on to gold. Okay, so for gold, we are actually stuck in this downtrend channel for now. So this year, right, we actually broke out of this consolidation triangle, and we retested the peak made in 2020. Then afterwards, we stuck in this downtrend. Then the key resistance level is around 1,780 to 1,800. Yeah. Then from the trend wise, we could be seeing a retest of this key support region around 1,680, which is there's a confluence of support formed around many times in the past, from 2020 until now. Yeah. Okay, next one, Oceanus. Okay, so this stock was actually in a bullish trend back in last year. Then afterwards, changed to a downtrend, and there was a very well-defined long-term downtrend channel formed. So short-term wise, I think that if this support cannot hold, this support at 1.3 cents to 1.5 cents can't hold, right? Especially after the sell-off, after the earnings accompanied by high volume, we might be seeing it tag to the lower end of this trend channel, sorry, to maybe 0.008, which was a key resistance level, which might turn to the demand level in future. As for resistance wise, short-term wise is around 0.018 to 0.020. Then further upwards, it will be 0.023 to 0.025. But the trend is still isn't looking good, and there's a high chance that it continues to hit lower. EIEO is a oil and gas exploration and production ETF. Okay, this one actually looks pretty good. So you can see at this resistance level, right? And stock actually made an inverse head and shoulders bullish formation. So the region around 84 to 87 region will probably act as a strong level of support for now. Recently, the stock to this resistance level around 97, and we saw a shooting star candle with a bearish pattern here. So if the stock actually, there's a chance that it might come back to retest this region support level before it hits higher to retest the high at 106 region over here. Okay, then I'll cover some of the major the ETFs or covering the major indexes. So okay, okay, now first. Okay, so for the SPY, we saw a relief rally recently from June all the way until August over here. So it tagged to the 61.8 Fibonacci retracement level, and then currently we are currently experiencing some pullback. So the short-term support wise will probably be around 390 to 398, as we broke out of this resistance level previously. So this will act as a level of support. And then as for resistance wise, if we break down, right, then this cluster over here and this cluster over here will become a resistance at around 410 to 420. And the higher end of the resistance will be the swing high form over here around 430s. Yeah. As for QQQ, okay, so this is actually similar to the SPY earlier. So there was relief rally, then we take to 61.8% retracement level. Then also similar to SPY, the support region is short-term support region of 303 to 313, then lower end is around 288 to 296, 297. Then the resistance wise is this swing high form over here, 325 to around 333. Yeah. Next one, the last one will be Dow Jones. So actually Dow Jones is stronger than the rest, because during the relief rally actually bounced to the 78.6% Fibo level, but then also encountered a pullback. So the support wise could be found maybe around 315 to 320. Yeah, previous resistance level probably formed into a support level over here. Then resistance wise, it will be the swing high at around 340. And next I'll cover on SGX. So actually this stock, after the bullish trend form in 2021, right, there was a strong downtrend form, and then it's pretty weak as from the Fibo level high to the lower right. actually bounced to only 38.2% the level. And then currently is in a very big sideways formation. Then the resistance zone is around 10 to 10, 1013 over here. Then the support wise, it can be found at 930 to 940. So we are likely to see it probably see it tag to this support region over here before the stock decides to move up again. If it breaks down, right, then we could see come to the lower end of the support region, swing low here around 893 to maybe around $9 over here. And then next one, Franken. So for this stock, there was also a buy call made on pulse where saw there was a double bottom pattern form over here, and the stock has making a series of higher lows and higher highs over here. However, recently, due to the broad market condition, is currently struggling at the trendline support region over here. So it's important that it continues to make a higher low before the stock can make upwards move again. Then unfortunately, if it breaks down this swing low over here, right, then we might have to stop loss. But there's still a chance that the stock could move back up to the resistance zone at around 140 to 152 and around 165 to maybe 180 thereafter. Okay, someone asked if I'm using a paid version of TradingView. So currently I'm using the free version, but I feel that it's good enough for me because you can use up to 3 indicators. I feel that we don't have to use so many indicators now. Yeah, if not, it will make our chart confusing. A few is enough, and mostly what I do is I'll draw all the supply and demand levels, and then draw some trend lines and patterns that I can see. Then indicators are just to like complement my analysis of, yeah. Okay, next one. Okay. So okay, I'll cover the banks, local banks names, DBS. Oops. Okay, so for this, there was also a downtrend being formed. You can see the lower highs and then the lower lows being formed. So short-term support wise could be found at possibly around $31 to $32. Then the lower end is this swing low consolidation at around 29.5 to 29.7. Then resistance is this swing high at 33.5 to possibly this next swing high at 34.38. Yeah. Then we compare this to another local bank, UOB, also similar. Also can see series of lower highs and lower lows. Okay, then for this, the resistance is likely to be found at around 28 to 29.5. Then the demand zone is around 25.9 to 26.4, 26.5 around here. Yeah, but it's still both are still in a downtrend for now. SDS, it's actually this one is a Malaysian stock. So okay, let me see. Bullish based on the higher lows and higher highs being formed. As we can see this, and currently is at the previous swing high over here formed in April last year. So probably there is some selling pressure over here at around 48.5 cents. Then but previously there's no further data. So if it actually breaks out of this, right, then we could form some could possibly form higher highs that not sure where's the reason for until we see more price action. Then for support wise, we could probably see around 40 cents to 43 cents over here. Yeah. For DXD, okay, previously there was a bullish trend over here. Then currently she broke down a bit and possibly could try to retest. Okay, let me see the Fibo level. Okay, so I think we could see a retest of probably around this region, around 47 to 49, which coincides with the 50% Fibo level over here. Yeah, but generally it's still in a downtrend. Yeah. KLIC. Okay. For this, since there was a downtrend channel being formed, you can see. Okay, then resistance wise, it's probably at we can encounter resistance at 51 to 55 over here. Then the support will probably be this swing low form at around 37 to 30, almost close to $40 over here. Yeah. HP. Okay, so for HP, it looks to be bearish for now. Okay, because of this, there was this previous demand zone, right? Then after we broke down, we can't retest it. So this could possibly be a resistance area, which lies at 33.5 to close to $36. Then demand wise, we are likely to see it at $30 to around $31. Yeah. Then if we break down, then possibly we will come to this region at around 26 to 27. Okay, PhillipCapital, also downtrend. And see there was a downtrend channel being formed. Then for resistance, will probably be around here. The previous support area was 15.4. Then around 14.7 to 15.4 likely be the reason because of this breaking down of this demand level previously. Then the support wise will probably lie at 12.5 to 13.2 over here, which is the swing low form over here. Sorry, CLI. Okay. Can you clarify what does CLI stand for? Because I'm not sure. Okay, someone asked Salesforce. Okay, so also downtrend pattern this year. Looks like we are stuck in a sideways formation as of now. So the resistance wise, it's 185 to 195 over here. Then the short term, then support zone is at 154 to 160. So yeah. But careful if we don't hold this region, right? Because of this strong downwards move over here, we could actually hit lower to another support level, which could be found at maybe 137 to 147. Yeah. Okay. So okay, CRI stands for Capital Land Investment. Okay, so for this, it looks like it could be near the end of the uptrend because we saw a nice little uptrend channel over here. But then currently we see that price hasn't been making a higher high. In fact, it made a lower high as of now. Then also we can see that lower low is being formed. So it could be changing from a bullish to a bearish trend. Then short-term support wise is this region. So you can see that there was a consolidation area around here. Then there was a swing low around here. So 360 to 370s over here could provide some level of support. And then resistance wise will be around close to $4 to $4.10 region over here. So I'll cover the last TA question. It's on VGL. So this one clearly is a downtrend pattern being formed. For possibly be trading in a sideways pattern for now. You can see the resistance lies around maybe $72 to 74 region over here. Then the support level based on this swing low is around 66 to 68. So I guess we'll be trading possibly in a sideways direction over here. Yeah. So that's all for the technical question. I'll pass back the time to Paul for the last question.
Okay, so thanks everyone for the question. Let me just take on this last one. Based on the current state of the market and global economy, what are the sectors to look out for potential going forward? Example, oil, natural gas, healthcare, real estate, gold. For very short term, I think if you're taking a short-term view, maybe the next 6 months or so, I think the sectors we like is actually like coal. The reason for coal is once Europe unhinged themselves from Russian gas, they even have to start up some of their coal plants. So we think the demand for coal will be also resilient, and the drought in China will also be another a stimulant for demand for coal. I mean, this is just our short-term, 3-6 months view. And again, the other one we like is also maybe Chinese property, because the sentiment is just so bearish. So we think any news of an uplift can carry these stocks. And property stocks in general are very high volatility and short trading time periods. So these are the ones that we probably like in the tactically asset class in the maybe 3 to 6 months point of view. Okay, with that, I'd like to thank everyone for your time, and thanks for all your questions, and hope to see you next week and have a good week ahead. Thank you, everybody.